Hey, hello friends, this is Martin from Secret, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis show where we look at what happened in the markets during the previous week, and also we'll try to plan for a better trading week ahead. And that starts from tomorrow. Sorry, it starts from Monday, day after tomorrow. I'm recording from Saturday. January 27, Monday 2025 is where the next week begins. So let's get started. Curious at bird's eye view weekly charts on the Nifty. On the right side you have the Nifty itself, but it's a daily chart. So clearly within two trend line channels, the parallel channel seen on the daily as well. Narrowing as a big wedge is seen in the Banknifty on the weekly, and within a trend line parallel channel in the case of Banknifty on the daily. Let's see what exactly happened last week. So the market remained weak and it remained volatile, and it further fell down nearly 0.5%, 113 points, and it remains below the 20 and the 200 exponential moving average. So that's about 12.5% of correction from the low, from the top. Remember, we had a 72% of rally since June 2022. Banking index also remained weak and sliding down and volatile with 177, almost the same percentage of fall that had happened last week, and remains below the 200 exponential moving average, and the correction is more than 12% now. So that's the story. Now if you look at the candlesticks, you can clearly see that it's bearish, and it has engulfed the previous week's doji completely, right? And the body as well as the wick. So it's a bearish for sure on the weekly. And daily, if you look at we'll look at the daily on the next charts. We'll look at Banknifty also. It's also having, I believe, wide wick, which indicates the attempt to move up, but that body looks like an inverted hammer. Inverted hammer during a trend up or down indicates there could be possibility of reversal. So that way we could expect a move from the Banknifty if the price moves around the high of this candle, weekly candles, right? So otherwise it remains bearish. Now the daily candlesticks of Nifty, if you look at, we can see that it was horribly volatile. Last 5 days candle indicates volatility as well as sliding down, and a small recovery attempt on Wednesday and Thursday, big fall on Tuesday, and unable to sustain the previous 2 days of is what you see on a Friday. Overall, it's 0.5% down is what you see in the indices. Banknifty daily also indicates the same, very volatile, up and down, finally sliding down 0.5%, and same. The last 2 days and Tuesday was unable to hold on the small gains that it did on Monday and Wednesday, right? So that's the story. Bearishness all around. Candlesticks are bearish in nature. There's some inverted hammer, almost like, not exactly inverted hammer, but those inverted hammers demonstrate the volatility that has happened, and also the indecisiveness that is there because of the small body of the hammer. And there is weekly hammerish pattern on the Banknifty, which gives us a possibility of reversal from here. All demands, if you see, it's also bearish in nature. Look at this. There is no hint of a contraction at all on daily. It's expanding downside, and it clearly indicates that more downside can happen for sure on both indices. That's more momentum. Momentum is bearish, no doubt about that. Look at this. Momentum is sliding in the Banknifty weekly. Also, it has slipped down to the bear zones. Medium to bearishness is what Banknifty is. Well, Nifty managed to hold on the sideways, but it's bearish momentum on the daily. RSI is what we use. So ADX is, if you look at the ADX, you can clearly see that it remains to be bearish in trend in both indices, both the time frames, weekly and the daily both. So absolute bearishness is what you see. And if you look at the volatility, the India VIX is the primary indicator for that. It's 6.2% for the spiked up, and it's nearly 16.75 is what's close, and it's getting into a high volatile regime. You have to be extremely careful. Open interest analysis, if you see, it's a short build-up, no doubt about that, but there's one mistake here. It's not short build-up, it's long unwinding, right? I've corrected in the slide here. It's a long unwinding. So let me correct it right away. So it's for the 30th Nifty That's a monthly expiry, and the levels of the PCR remains to be bearish, 0.8 and 0.5 Nifty in the Banknifty, but the expiry date is corrected for January 20th, and it's long unwinding is the last build-up that you see on Banknifty. Long unwinding is bearish in nature itself. So below charts that you see is that of the open interest for the Nifty and the Banknifty, right? So based on that, the levels are marked here down. For the highest resistance is highest support resistance on the Nifty for this coming expiry is seen at 23,000 and 24,000, where the highest put and call rating is seen. Second highest at 22,500 and 23,500, where the highest put and call rating is seen. For Bank Nifty, 47,000 is where the highest put rating is there. 50,000 is where the resistance is there and the call rating. Second highest put and call rating is at 47,000 and 49,000. PCR is definitely bearish because it's 0.8 and 0.5 less than 1, so bearish. Futures I have already seen short build up in Nifty and long run in the Bank Nifty, which is definitely bearish. So these levels, that is as of now, it may change next week. We have another 4-5 days, and monthly expiry are usually very volatile, but keep that in mind. It may vary, but it gives you good indication of where the next immediate resistances are there and supports as well. But these numbers that you see is a 20 exponential moving averages, previous swing lows, Fibonacci levels, and previous resistances, and all that. That is derived from these two charts, where the level. So you have to basically correlate between the data that is the levels that is derived from the data on the open interest and the charts, and then come to a conclusion where the bets can be placed on the upside and downside, right? So definitely this is Nifty's charts, and it shows that it's a parallel channel breached, another parallel channel for a space to go down as low as 22,000, and for supports will be seen at it's the swing lows at swing lows that comes in at 23 154 20, right? This level is what is marked, right? So once that swing low is covered, then it goes to 22 800 nearby, and then 22 526 likewise, right, towards the bottom of 22,000. Upside, first immediate resistance will be 20 exponential moving average at 23 422. Go for that Fibonacci 23 154 resistance is there, and then 23 600 is for the 200 exponential moving average. Then after that you have 23 796. Then 24,000 is a combination of the 100 exponential moving average as well as a rounding number. Similarly, Bank Nifty, it's almost near the bottom. So the previous lows at 47,676. What you can look forward is a combination of Fibonacci 78 as well as the previous low. So if that is breached, then it can go to the 46,900, 46,574, and then 46,077. This is the previous lows. 45,834 is what you can see after 46,000. Rounding number is also breached if it is breached. That's supports and downside. Upside, first resistance would come in at 49,479, where the 200 exponential moving average is, right, with 20 exponential moving average there. Then you have 50,150, where the 200 exponential moving average is there. Then 55,29 and 59,100 is where the 100 exponential moving average is there. Rounding numbers of 50,000 and 51,000 could act as resistances as well. So all those details are put in here. Have a look at the charts and then have a look at the open interest as well, and then come to that conclusion. So the levels, supports, and resistances. Moving ahead, we're trying to understand how the different sector analysis. Story is very clear. The IT that followed last week, nearly 5% or more, has recovered. Otherwise, the FMCG is slightly showing some green, otherwise it's all down. And the biggest downfall is happening on this reality sector. Look at this. Reality had a big fall, big fall. Momentum has slipped into these bearish zones, so reality hit really bad. FMCG and IT is different. See, they're managing. IT is doing good, but still it has to move above the sideways for us to clearly take long positions. And stay away from auto. This 2.7% hit and 1% pharma is a defensive, but it's also falling down. Actually gained last week, but 1% down this week again. So it's all sideways everywhere, and reality, in fact, is one of the sectors falling to the bearish zones. Also, that's these are explained here. Here we have the IT on the top. Then it comes to FMCG, which is consolidating at the bottom of the channel. The channel median is breached in the case of auto and seems to be falling down. If this momentum supported RSI 40 also is breached, pharma struggling at that channel bottom. FMCG at the bottom consolidating. In reality, seems to be making big corrections with medium-term bearishness in the moment. I'm also seen there. Let's look at the index heavyweights. Look at that HDFC Bank is showing some green, but it is in a correction mode. It is moved from more than 1,800 to 300 points fall has already happened, and there's scope for more. But it seems to be consolidating in the median zone of that parallel channel. So keep a watch on that. Probably buying opportunities if the banking index managed to stop the correction somewhere at 48 or 46. The buying opportunities on the HDFC Bank. Lens has still recovered and showing some divergence and climb back into sideways. Seems to be not interested to further fall down from this 1,200 levels. Probably that was a buying opportunity. But previous week candle is heavily bearish, so it seems to be taking it up on the RSI 40. We'll have to close watch if it is able to do that, or is further sliding down towards the bottom of the channel, towards the 1,100 levels or not. So keep a close watch, and you have red and the lens struggling to catch up with the reversals momentum that it gained previous week. HDFC Bank is also losing grip and heading towards the bottom of the channel, trying to sideways and falling. So idea is the only thing that moved, and you can see that it's really sideways since rising up. Kodak Bank, as usual, is a contrast stock and it's always remain sideways. FMCG side is showing some green, so IDC is also moving, but sideways. So everything is sideways and struggling is what you can see. If you look at the major index heavyweights, index indices, industrial indices, and the heavyweights. So if you look at the broad markets, things are not that great. We have a wide range bearish candle, but momentum is yet to slip into the side into the bearish zone, so it's still sideways and falling. So keep a close watch. If the broader markets are also unable to hold on and move to the bearish zone, we may have deeper corrections here. Institutional participation continued to be big, 22,500 crores, 25,000 crores last week, and FIS and non-stop selling is what the market is falling to. Yes, it's trying to buy more to balance the fall, and 70,575 crores of buying that has happened from the domestic institution, but foreign institution selling is why the market is falling. Big channel there. A lot of money is getting pulled out. Now if you look at the global markets, the currencies and the commodities, let's begin with the currencies. Currencies have finally dropped. The US dollar index has dropped nearly 2% and fallen to sideways momentum falling. It's about 7.47, so rupee has strengthened slightly. The US dollar also has 0.5% down at 86.14 after it shot up earlier weeks, so to very close to 87. So it has gained something, that's a relief. And crude oil has also fallen down after getting the top with the 3.5% downfall, and gold is spiking up. That's where the trouble is. Gold is at all-time highs. It's a rounding pattern. It can break out from here. Gold usually gets in more money and then spikes up when there is a shift of equity to gold. So equity markets could fall further. It's what's indicative, which is a worry. But as a hedging instrument, people are it's good news that gold is green and at all-time highs. The US markets, if you see, Drawdowns green, Nasdaq green, and S&P 500 also green, all heading to all-time highs, with the momentum climbing back to the sideways after a smaller correction that has happened. So mother market is going good, is why those can hope for some pause in the corrections in our markets as well. But the US tariffs price remains there. It's a fundamental trouble. Two stock picks for the next week, one is on the downside, one is on the upside. Wipro is breaking out with the cup and handle, good volumes, momentum rising, trend rising, cup and handle pattern on the price. So good looks about 1:2 can be looked up. The reality is breaking down, so Godrej Properties is a short sell with the momentum in the medium term sliding down, and trend also closing out with bear zones and rising up in strength, and 1:2 square can be looked at here. It's breaking down, it's head and shoulder, it is breaking down the supports and big volumes as well. So Godrej Properties is a short sell, and Wipro is a long call. These are not recommendations from my side, right? These are for indication purposes, and you can understand the charts, and if you think that idea works with your risk appetite and your idea as well, then you may take the trade. That's up to you. This is not a trade recommendation at all. Ignore that. And you have enough in a strategy also for next week that you could try to understand from these charts. These are the charts that you see here. This Batman strategy, but not completely justified. There are no wings on both sides to protect it completely. So get out immediately when the break line levels of 22,500 and 23,700 on the upside is breached. Immediately get out. Property profit in the RiskReward is reasonably good. But if the market is consolidating mode, then we have trouble. But if it is having a swift recovery or a further crackdown on either side, not too much, under 2500, if that crackdown is happening, then we may gain. So it's a bad strategy where you are selling for OTMs on both sides, and inside hedges are taken by buying half the quantity of what is sold, at OTMs, for OTM selling, and half quantity inside hedge buying. That's what Batman was. So you could buy some protection on both the sides by buying further for OTMs and of the same quantity as what inside hedges are there. You could do that, but you will hardly have anything left. If it were in the strategy. That's why that's not immediately get out, no corrections and no adjustments, nothing. Just get out in case these levels are breached. Levels are clearly mentioned here. So that's FM strategy on the Nifty weekly for the next week. Batman strategy. And let's try to wrap it up. So market remains more weak as volatile as last week, sliding down further and closing negative. It's 12.5% of correction and 12% in the Banknifty. That's where we are. Market remains with the grip of bearishness just like last week, and momentum has slipped further down. The price are selling heavily. So we're trying to bucket to the what is in favor of the bulls and the bears. Bulls just have the fact that the US market is green and the gold dollar has cooled off a little bit. But for the bears, a lot of things. The price is selling spree, openness is negative, candlesticks are negative, price action lower, high patterns negative, Bollinger Bands are negative, sectoral indices and broader market indices and heavyweights are sideways. Some of them are even falling to the bearish zones as well. So overall, if you look at the indices, the trend is bearish and the momentum is falling. So we have some of the momentum is below 200 exponential moving average, and 20 exponential moving average has crossed our downside of the 200 exponential moving average. So we have trouble as per the technical chart. So the view is very clear, it's moderate bearish. So always keep in mind that whenever there is a black swan that happened due to many of these reasons like war, pandemic, recessions, interest rate policy changes, tariffs and all these things, then obviously the technical charts will not work. But otherwise, it gives an indication where the resistance could come and play or where the supports could act. That's what technical analysis is all about. So according to me, for the next week, 20,000, 24,000 is the levels on the upside, on the downside and upside for Nifty, and 26,000, 46,000 and 50,000 is where the Banknifty levels can be looked at. As long as it's 26,000 and 54,000 is maintained, is conquered, not maintained, is conquered, then only we can think of a continuation. Until then, we're either moving down or we're disconsolidating, right? So always keep in mind that hedging strategies can be used for making rental income using covered calls and cash together puts and all that. Check out the playlist for that, and always protect your capital and have clear stop losses and hedge your portions as well as the portfolio for sure. Capital is already got. So that's all I have. I'll subscribe, like and comment in case you like it. If you like the content, share it to others. And I'm also active in the other social media channels. Primarily I'm on X, where I post regular technical analysis. You can subscribe if you like to. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.